Good afternoon. I'm with Nick Campbell of Mayfair Gold. Mayfair is a new company to Goldfinger Capital, but they're not a new company. But we're going to learn about it today. Hey Nick, how are you?
I'm excellent. How are you doing?
I'm doing good. I'm looking forward to learning more about Mayfair. I know a little bit, but I want to learn a lot more today. So tell us about the company and why are you the CEO?
Great question. So, first of all, the company Mayfair Gold, our flagship is the Fenn-Gib Gold Project in the Timmins area of Northern Ontario. So it's a 4.3 million ounce indicated resource that has amazing access and infrastructure, and so that's our focus. And basically, my focus has been how can I get this asset and bring it into production. And so I was brought into the company as a result of an option proxy battle. So Muddy Waters is the largest shareholder of Mayfair Gold, and they started an option proxy battle for a variety of reasons with the previous management team. And in 2024, the management team was removed, the board was removed, and then they approached me to come in and take over the company. So I actually started with the company in a different role because I needed to figure out how to move the asset forward. After I came in and did due diligence, I came up with what I think is a unique strategy to try and get this asset into production, taking advantage of the high-grade starter zone and going through a provincial permitting process to get this into production. And most importantly, so I was brought in. My background is the previous company I was working with was Artemis Gold. Before that, I was with Silvercrest Metals. So the last two companies I worked with have been pretty successful, and they were both pretty successful by bringing development stage assets into production. So I'm a big believer in the value that can be created by taking development assets and turning them into new producers. And so I think we have a very unique strategy in getting this into production. And I brought in Drew Anwyll, who's the CEO of the company. Drew built Detour Lake, which is the largest open pit gold mine in Canada. He's a serial mine builder. He's recently gone through the provincial and federal permitting process at Generation Mining's Marathon PGM project. So he is uniquely qualified to help us get this asset permitted and to also manage the execution of the build and manage the operations of the mine.
Very good. Yeah. I would say that Silvercrest and Artemis is a pretty good track record. Let's see if you can go 3 for 3 here with Mayfair. So you put out a PFS. So obviously, like the PFS is the meat of this conversation, diving into it and really understanding what the plan is here. And what stands out to me is you start in year 1. I mean, as soon as the operation is built and you're ready to go, year 1, year 2, year 3, you start with higher grade. And obviously that means more ounces of gold. And that's faster payback. So just because of the unique qualities of the ore body there at Fenn-Gib, you have like a higher grade core zone that's near surface. That definitely gives you some advantages. Why go smaller as opposed to going larger?
So when I first joined the company, Mayfair was looking at a 25,000 ton per day throughput operation. They're working on a pre-feasibility study for it, and there's a variety of reasons why I shut that down. The first was that there wasn't any management oversight, and you need to have technical bench strength. You need people that are helping to manage that process to make sure that things are done properly, or you're going to have bad information going out to the market. But what I did is I did an audit of the federal permitting process in Canada when I joined, because I really try to understand permitting before I make any decisions in terms of investments. I've put $2 million into this company on the basis that I think there's a way for us to get this permitted. If you're over 5,000 tons per day, you have to go through the federal permitting process. And they made changes to the federal permitting process in 2019. They passed IAC 2019. And as part of the audit, and this is something that kind of hit me like a slap in the face when I was going through it with our environmental consultants. You have to do a gender impact study. And I don't know how digging a hole in the middle of a forest affects someone's gender identity. I don't think anyone knows the answer to that question, but that's the kind of thing you put in place to stop development. It's not the kind of thing you put in place to protect people or to protect the environment. And so there hasn't been a single company, not one, that has received an approval, a federal approval of their environmental assessment since IAC 2019 was passed. Any environmental approval that's been approved since then was grandfathered as part of the 2012 Environmental Assessment Act. And so it's not that there is a big mine to be built here. We could have put out a pre-feasibility study that shows that we're going to exploit 3 to 3.5 million ounces, but that would have cost over $1 billion for us to build. It would have taken us over 10 years to get through permitting, and that's just not interesting for me. So instead, and you'll see there's some similarities to the way Artemis approached the Blackwater mine, because Blackwater also had a high-grade core that they focused on at the beginning of the mine life. We've got a high-grade core of about 10 million tons that we can focus on at the beginning of the mine life. So for the first 6 years, it averages around 1.47 grams per ton that we're feeding to the mill. In the PFS, we have a 14.3-year mine life with an average grade of 1.29 gram per ton. That's a pretty good grade for an open pit, but it's really good at the beginning of the mine life. And the best grade year you get is the first full year of production, which is year 2. The average grade is 1.68 going to the mill. You're producing over 80,000 ounces of gold. And it's a different gold price environment today than we've seen in the past. And a lot of people fixate on, well, no one's going to care about 70 to 75,000 ounces of gold per year. I don't really care how much gold I'm producing. I care how much free cash flow I'm producing. And so you can look at the PFS at a $3,100 gold price. We can generate $896 million in free cash flow over the first 6 years. That gives you tons of optionality to look at opportunities, to regional opportunities to grow the mine, look at a secondary asset to grow throughput and grow production. Or if you look at spot, and I'm a believer in gold, that's why I'm here, that's why I put my money into this company, and that's why I'm running this company. I think we're in the middle of a generational gold market for a variety of reasons. And so if you look at spot, it's 1.4 billion in free cash flow over the first 6 years. So that's a lot of free cash flow. That gives me lots of optionality. That allows me to potentially buy back stock or grow the company. And I have a team that knows how to execute. So we've been very specific. We've been very targeted in terms of how we've built out the human capital in the company. We are a company of mine builders. We are very engineering focused. Drew has a group of people that is working with him on a consulting basis right now that we will be bringing them on over time to help us build the mine. But we have a team that can execute this build. We are designing this to be something that we can stick the landing on. And if you stick the landing on a build, you're going to get a premium valuation in the market. We want to create a new Canadian gold producer. We could do that within the next 4 or 5 years.
Very good. So what stands out to me is the initial capex is only 450 million, right? And potentially you're talking about a payback period of less than 2 years at Fenn-Gib, with the plan that you have. So that does really stand out to me. In 2026, I'm usually looking at initial capex above $1 billion for almost any new mine that's going to come into construction. But so this is a lighter build, but also it worries me. Is that an accurate number? Like, how can investors have confidence that that's the right capex bill?
I think that is actually a great question. And so I was a mining analyst for 10 years, and I'm a very cynical person when it comes to economic studies, because usually I can find a problem with them almost immediately, right? And what's your mining cost per ton? What's your processing cost per ton? Now, the reason why I feel really comfortable with these numbers is that it was driven by first principles, and it was the whole process has been managed by Drew Anwyll. Drew is a blunt guy. He's not trying to make this look pretty for someone else to acquire us. We're using this pre-feasibility study. We're probably going to be using this to engage with debt lenders. They're going to be way more diligent. Project debt lenders are way more diligent than any kind of investor that's looking at any kind of equity investor that's looking at putting money to work. So we're comfortable with the numbers that we have. They're like, we've had a few people question the processing cost per ton. We're comfortable with those numbers. We think they're comparable to other operations that are in production. In terms of the capex number, 450 million, that's not a small number, but it is in the context of what the payback is, right? So if you're looking at other assets, you're looking at much bigger operations. We're talking about a 4,800 ton per day operation. So 450 million bucks is not like, that would have been a heavy lift like 5 years ago, right? But today, 450 million bucks, your payback's less than 2 years. It allows you to put on probably around $300 million in project debt, and the payback on that is going to be really quick. If you have a bigger capex number, if you're looking at a bigger project, yeah, it's going to be a bigger number. There's more scale. It's probably a little more appetizing for a larger cap producer, but the permitting process is much longer, and you're probably going to have to raise like $600 or $700 million in debt. That puts your company at risk, right? So for a single asset developer, we've designed this to be something we can execute on a technical side, and something we can fund ourselves.
Very good. So funding it yourself, right? So that's a big thing, because I see some companies with market caps of like 300 or 400 million, and they have projects that have an initial capex above $1 billion, and
Yeah.
that's a big lift, right? That's a big lift. There's a lot of dilution there. And there's probably going to be all kinds of royalties that have to be given out, and debt. So what
and royalties, and so like I focus on cost of capital, right? I'm an investor in this. I want to reduce my cost of capital as much as possible, because that improves my returns. Royalties are the highest cost of capital. Debt has lots of strings attached to it. So if you have too much debt, it can actually affect your ability to operate and execute, right? So a modest amount of debt, something that's executable, we're going to have to raise probably, if we're looking at $300 million in debt, you're looking at another 250 million Canadian in equity that you have to raise. That's very manageable. We don't need to raise money today. We've got $40 million in the bank. We did that purposefully, so we don't need to come back to the market anytime soon. We will have to come back to the market at some point in time, but we can deliver on some catalysts, unlock some value, get a better cost of capital, and we can raise most of that equity after we get our permits in place. And you see it time and again, once you get your permits, you're going to get a revaluation, because most people are going to be skeptical that you can get your permits in a timely fashion.
Okay. So tell us about permits then. Let's talk about the Ontario mine permitting process, and also tell us about the First Nations that are involved here and what kind of agreements that you have with them.
So we do have an exploration agreement with the Abitibi and Nishnawbe. I'll start with First Nations. There's 5 different nations that we're going to be engaging with, but the Abitibi, our project is located within 15, 20 kilometers of the community of the Abitibi and Nishnawbe. So that's a community that is very important to us. We want to work alongside with them. We've been in discussions with them for over a year. And we're hopeful that we can get a process agreement in place with them sometime soon. And we're going to be working with them to try and establish an impact benefits agreement so we can have them as partners, and so that there's mutual benefit as we advance the Fenn-Gib Gold project. It's just best practice to try and get some alignment with First Nations, and it's also part of the permitting process. You do need to go through the consultation process as part of any permit, either provincial or federal. What I would say about Ontario, which is great, is that they've established a one project, one process in Ontario. So the 1P is designed, the spirit of it is to try and reduce permitting by 50%. And the idea behind it is there's all these different ministries that all require information, right? So you've got the Ministry of Environment, you've got the Ministry of Mines, you've got the Ministry of Forestry. Like, there's all these ministries, they all require things from you. And so instead of having to go and do the same thing for each ministry, you bring that all under one house and you manage the process, so you're not duplicating and having redundancy in terms of the kind of questions that are asked within the government. And so that they've established that process. You have to apply to go into that process. It's very specific in terms of how you do that. So we've modified our permitting application in order to be able to go through the 1P process in Ontario. We think that, you know, it's possible for us to get all of our permits in place within 18 months. I wouldn't expect that. I wouldn't say that that's what investors should expect, but it could be anywhere from 18 months to 3 years to get our permits in place. We think we'll probably have all our permits in place sometime in 2028.
Okay, so based upon the current timeline, the mine will be built in 2029 and 2020 and in 2030, and then you'll start the ramp up in 2030.
So what we're trying to do is we're trying to get an early works permit, which is a separate permit that you're going to apply for, which will allow us to do some site clearing activities and some pre-stripping activities in 2027. That will actually significantly de-risk our construction timeline. But you basically do that in 2027. It also gives us a bunch of nag material that we need to start tailings construction at the beginning of the construction period. The current plan is, if we get our permits by mid 2028, is to mobilize construction after the freeze up in the winter of 2028. So you start construction in 2028. It's going to be less than a 2-year construction timeline. It may be closer to 18 months. So you should be in production in 2030.
Okay, very good. So let's talk about the upside potential here, because there's a lot of numbers here in the PFS. You put some gold sensitivity data there in terms of $3,100 gold, $4,000 gold, current gold spot price. What's the upside here, and what is the plan in terms of, like, once this is fully permitted and in operation, what's the expansion possibilities?
So we could have looked at building a bigger mine right from the start, and, you know, it would have had a bigger NPV, right? Like, so this is one of the things that hurts you when you start on a smaller scale operation, is that, you know, we only have 1 million ounces in our reserves, and we have a 4.3 million ounce indicated resource. If we designed a bigger mine, we would probably be able to capture something between 3 to 3.5 million ounces within that mine plan, and you'd probably have an NPV at spot of, you know, $3 or $4 billion. So there could be an opportunity to look at going through a federal permitting process eventually. It just depends on what the environment is looking like when you're actually in production. There's also regional opportunities that you can look at. So we're building a mine that is going to be one of the biggest mills in the region, and we're surrounded by higher grade underground operations. So even if you're not looking at an expansion scenario, there could be potential to consolidate and bring some of these underground assets into it and sweeten your grade profile and grow your production without even looking at an expansion scenario. For me, what we are going to get is, we're going to get free cash flow, and that free cash flow is going to give you optionality. And that optionality could be, we're going to look at buying another asset. It could be, we're going to look at a regional opportunity. It could be, maybe if the environment is supportive, we might look at some kind of longer term expansion scenario. But, you know, for now, we're really comfortable with the economics of the mine we're building, and we think that the economics are strong enough to give us lots of optionality to potentially grow this into a much larger company longer term.
Who are the largest shareholders of Mayfair Gold, and can you tell us about some of the important key members of the management team?
Absolutely. So we have a unique share registry, and you know, my colleague Zion Lacani isn't on the call, but we brought him on. He's the VP of Capital Markets, and bringing him on was also a reflection of who we're trying to, what kind of investors we're trying to get exposure to. So I'm a mining guy. I've been in the mining industry for 25 years. I tend to talk like a mining guy. I tend to look at things the way a mining guy does. But there's a way broader audience in terms of generalist investors that are now starting to look at investing in the gold space. And so we've been able to attract some pretty interesting generalist investors onto our registry. Our largest shareholder is Muddy Waters. People are pretty familiar with Carson Block. He's more known as being a short seller. He made some news last year about his investment at Snowline. It hasn't quite got the same notoriety about his investment in Mayfair Gold, but really smart guy, and he's made a significant investment in Mayfair on the basis that we can bring this asset into production. After that, you've got Heaney Capital. They're the founders. They own just slightly over 10%. Below that, and Henry is committed to funding us through to production, right? So that's about 27% of the company right there. You have additional shareholders that are on the board. We've got 35% insider ownership. There's another 10 to 15% that are sort of, call it, let's say, friends or investors who invest alongside the insider shareholders that have committed to funding us through to production. We also got Oaktree into the last financing that we did. I think we're the only junior gold company that Oaktree owns. They put in an order for 25 million US. We had to cut them back to 15 million Canadian because we couldn't give them that much equity as part of the last deal. This is one of their new gold exposures within their portfolio. So we want to be getting in front of generalist investors. And so Zion, he's a former fund manager. He managed $4 billion with HSBC and then RBC. Zion's a generalist investor, and he joined the company because he believes in gold and he believes in the potential returns that are associated with bringing a development stage asset and bringing that into production. We're uplisting to the NYSE American. We're going to be making a broad push to get in front of new people because we do think we have a differentiated approach, that we're running this like a business. Our key management personnel are all focused on being able to deliver a mine, right? So Drew Anwyll is a key man. He's a serial mine builder. He recently went through the permitting process with Generation Mining. So he's uniquely qualified to help us navigate both the permitting of Fenn-Gib and the development of Fenn-Gib and operation of it. So Drew was a key member as part of the build for Detour Lake, which is the largest open pit gold mine in Canada. Most of the crushing circuits that Drew has designed and built over his career are larger than the mine that we're looking to build at Fenn-Gib to start. And so that's part of the strategy. We're designing this to be something that we can execute well. And it's hard. It doesn't matter if you're building a small mine or a big mine. It's challenging. It's challenging building a mine. But this is a mine we can build. We have the team to build it. We have a shareholder base that's supportive. That's important because it gives us confidence that we can go and raise equity in the future to fund what we need to fund. And I've been a part of two different companies that have navigated the permitting and execution associated with bringing a development stage asset into production. And the returns associated with those two companies were exceptional. Those are, every company's different. Mayfair is different, but this is the best gold price environment that we've ever seen. And this is an asset that should perform incredibly well in this kind of gold price environment.
You mentioned the uplisting in the U.S. I think that's a very important catalyst. What other catalyst does Mayfair have, ahead of it in 2026?
So there's going to be a number of catalysts that aren't that I would say they're de-risking catalysts that are important. They're related to permitting. They're related to engineering. These are all very important aspects of actually trying to get ready to build a mine, but they aren't necessarily the things that get investors really excited about. What I do think investors should be aware of is that We did a confidence drilling program within the high grade zone. It's 56 holes that we completed in December. Those results should be out at the end of this month, so at the end of January. And this is designed to basically do advanced grade control drilling. It gives you more data. It gives you better. It gives you a higher degree of confidence in what the grade tenure is going to be at the beginning of the mine life. That's important for payback. That's important for debt financing. But it's also going to show what kind of grade we have at the beginning of the mine life. So keep an eye out for that. We'll do a reconciliation between the block model, which is basically what feeds into the PFS, and the results that we have. So hopefully there's a positive reconciliation, but it could be slightly negative. It could be in line. It doesn't really matter to me. What matters is that we're showing that the high grade is there, and you're going to see some drill results at the end of the month. Beyond that, we're also going to be, there's a South Block, which is a highly prospective parcel of land that's along the Porcupine-Destor Fault. If you look at that fault, that's what hosts Stellar's assets, that's what hosts McEwen Mining's assets, and all the way up to Discovery Silver. So it has the right rocks, it has the right fault. There hasn't been much work done on it historically. We will be doing some exploration work on that property, and there could be a few other areas that we could do some exploration work on. Now there is upside at Fenn-Gib. However, there's a back and right that Barrick has. It's part of the agreement that when they sold the asset to Lakeshore in 2012. If you go over 5 million ounces on the concessions that made up the Barrick concessions, they have an opportunity to buy back 51% of the asset by spending twice what's been spent on the property. I'm not going to give them the opportunity to do that. So all the exploration work that does expire in 2032. So all the exploration work we're going to be doing is going to be outside of those historic Barrick blocks. But that means that we won't be able to really test for extensions, depth extensions, other extensions to the Fenn-Gib ore body until either we get that back and right removed or it expires in 2032. But there is other areas, other places that we can start drilling and start showing the market that there's more running room to this asset.
Are there any royalties on the project?
Yeah, there are. It averages to around I think 2.9% NSR, and they vary based on concession, but there's a royalty that's held by Pan American because we bought the asset out of Pan American. And then there's a variety, I think Metalla has a small royalty on the property as well. But it's a pretty modest amount of royalties. I will tell you that I will always consider different financing options. I think it's always good to have different options that you can tap into if you need to. But the royalties are the highest cost of capital that you can apply to a project, and you can never get rid of them. They impair the asset life of mine. So we don't have that much capital that we need to raise. So we'll likely try to avoid doing any fundraising related to a royalty.
Okay. So as far as the financing to build the mine, what do you think the debt equity split will be?
I'd like to raise about 300 million in debt Canadian. So that leaves about 150 million of equity that you'd have to put towards that. We've got 40 million in the bank. I think realistically, there's probably 250 million Canadian that we'll have to raise in equity to be fully funded for the project financing, also for overhead and working capital, right? So, but 250 million isn't that much equity that you have to raise to be fully funded. The 300 million in debt, that's not the lightest debt to equity mix. However, the payback is so fast. And the reason why the payback is so fast is the average grade in year 2 is 1.68 gram per ton, right? So your best year of production is 1.6 is year 2, and at spot prices, it's almost the current market cap and free cash flow for that 1 year. So it's a very juicy year. It really juices the economics, and it helps with your payback. So we think we'll be able to, we're going to start doing the work on the project debt financing this year. It'll probably take us 12 to 18 months to get some kind of announcement out to the market.
Okay. And I mean, obviously, look, that's this. The focus of the company is advancing Fenn-Gib and getting that permit there in Ontario and building a mine, but you also have a pretty big property package there in the Timmins camp. So what is the exploration, sort of upside here, and will you be testing any new targets in the next few years?
Absolutely. So, as I mentioned, the Southern Block is really interesting. So whenever you're looking at these big trends, we're on the Pipestone Fault, which is a big trend in the Timmins area. But you also have the Porcupine-Destor Fault, which is also a big trend in the Timmins area. So you've got these faults, and then there's certain kinds of rock types that are associated with the big deposits that you have in the area. So we have those rocks on the Southern Block. There has been limited drilling on the Southern Block. It makes more sense to drill it in the wintertime because access becomes an issue in the summertime. So what we'll likely look at doing is we're very much, our technical bench strength is more on engineering than it is on exploration. So we're going to be bringing somebody in to help us with targeting work. I do want to spend money on exploration, but I don't want to blow money on exploration. If we're going to spend money drilling, I want it to be targeted work that has, the best possible bang for your buck. And so we need to bring in some additional expertise. We're looking at bringing somebody in sometime in the next month. And there are some other targets that we may end up drilling on the property, which I'm not going to get into right now. We may end up folding it into some of the condemnation drilling we're doing on the property, but there are a few different opportunities that of parcels of property that have interesting historic results that are outside of the barrack tenements that we can do some work on. So I think we'll probably see some drill results there. I can't give you a notion in terms of what the exploration upside is. There's definitely more upside to the property, to Fenn-Gib, but we can't really test that until either we remove the back and right or it expires in 2032.
Once you're on the NYSE, is there a potential for you to be added to the ETFs, like the gold miner ETFs?
So the most likely ETF that we'd be added to would be the GDXJ, and we need to increase our trading liquidity. I had the same issue at Artemis. Artemis was 42% insider owned, and then you had some large committed institutional shareholders that meant it was about 70% tightly held. It's a pretty similar situation for us. And we had to grind our way through it too. And the threshold is you need $1 million US traded per day on average for 3 consecutive quarters. So we're not there. I think we'll get there, but it may take us a year to get into that index. Ideally, we'd love to get into that index in September, but we have a lot of work to do to be able to get that trading liquidity above that critical threshold. You need to do it for 3 consecutive quarters. So we've been a pretty tightly held company. We haven't really done a lot of marketing. We're now about to do a ton of marketing because we now have a PFS that we can actually go and tell people about the economics of this project. And we're ready to get on the road. And we are going to be very active getting in front of investors over the next, basically until the end of November this year.
Very good. So look, Nick, I'll give you the final word, closing comments. What can investors expect from Mayfair in 2026, but also for years to come?
Sure. So I think, I've been in the mining sector for 25 years. And I like to do things in a way that I think make the most business sense. And I don't think that always happens in the junior side of the mining space. And so we've tried to put together a team of people, a team of serious people to put together what we think is the best possible business plan to unlock the value of Fenn-Gib. And it's an asset that people aren't very familiar with, which I like because it gives us the opportunity to then go out and tell people and show people what we have here. And what we have is a hidden gem in the Timmins camp with a high-grade starter zone, with amazing access and infrastructure. And we have a mine building team that's built into the management team. And most juniors don't have that. And so we are going to build a new Canadian gold producer We are designing this to be able to execute this effectively and to be able to hit our targets. And we aren't going to have to go and raise a ton of capital to get that done. So this is going to be the year that people start to understand the potential of Mayfair Gold and the Fenn-Gib Gold project. And so I hope people will take a look. And anybody has any questions, we're here to answer them. We want to bring more people into the tent so that we can all do well together.
Nick Campbell, thank you.
Thank you.